Okay, in this video, we're going to go over the chapter 5 exercise number 2 problem. Okay, so what do we do here? So there are 5 information related to Duffy Corporation Limited presented below. So what we're supposed to do here is to prepare journal entries. I see many of you who did not know how to do entries in your exam. So you should be aware when it is stated that do journal entries, you just do 분계. Okay. Um, Anyways, so let's go over and from number 1. On April 5, purchased the merchandise from Thomas Company Limited for $25,000. Terms 210 net 30. And freight on board, shipping point. Okay. So basically what it's saying is that this company, Duffy, there is two company, Duffy and Thomas Company. And Duffy bought some merchandise from Thomas Company. So Thomas is going to send Duffy some inventory, right? And Duffy, on the other hand, will give cash or some equivalent cash equivalents. So what we are supposed to do here is that we see this term 210 net 30. So 210 net 30 means that in 10 days, if you pay in 10 days, so many times business transactions are on account, so it's either account receivable or account payable, so you have to pay in near future or you have to receive in near future. So 210 net 30, this term specifies that if you give money or if you pay money in 10 days, then you'll get 2% discount. And if you pay from 10 days and on, there is 0% discount. That is net. So net is just the same amount, the total amount. There will be no discount. Okay, so one, you have to, the first one, you have to record that for you're the Dolphin corporation, so you have to record you're going to receive inventory, right? Inventory will be increased by $25,000, and you're going to pay in the near future. So account payable $25,000. Okay. Number 2, it says on April 6, paid freight costs of $900 of merchandise purchased from Thomas. So on perpetual, so if you so when buyer buys merchandise to sell again in the near future, you treat freight cost as a cost. So for number 2, basically, what you have to know is that how are you going to deal with the cost, the freight cost or delivery expense, freight cost, delivery expense. So, are you going to see it as a cost, or are you going to treat it as an expense? Is it expense or is it cost? So it changes from entity perspective. So what I'm saying is for buyer if buyer pays, no, let's do it like this. Uh, this is a merchandise company. So this is Duffy, and this is the Thomas. So, and Duffy is going to sell this product to many other different entities, people. Okay, so now Duffy needs to buy some merchandise from Thomas to sell to people. So Duffy pays account payable and receipt inventory. Now that Duffy has paid again Thomas the delivery cost. Delivery. So how are you going to um, journalize this? For Duffy, so for Duffy, uh, the freight cost is cost. So you have to increase inventory. Okay. Um, so you have learned this. When there are two entities, this is A, and let's say this is B, and this is a truck. So this is the um, shipping point, and this is the destination. So the problem here is that the ownership problem occurs. Why? Because nobody wants to take responsibility when something happens during the transportation of goods. So you never know, this car will be in an accident and your product will be lost. So who's going to take responsibility? Some person or the entity who has the ownership should take responsibility. That's why we purchase insurance to cover the risk, to hedge risk during transportation. So, um, anyways, so just remember, how should I explain this? Um, for buyers who buy merchandise from factories from Thomas, they will record inventory on their debit, and they will pay account payable in the future, right? But let's see what happens when the Duffy sells. So this is the purchase. So this is sale. So when there is sales revenue will increase, right? And you'll receive account receivable or cash equivalents. Then, but you also have to do what? You have to decrease your inventory. Wait, decrease. You have to decrease your inventory, and you have to increase the cost of goods sold. So what you can see here is that inventory is transferred to your customer. So the whole point is that buyer, in this case Duffy, if treat delivery cost as cost, then they can transfer their freight cost directly to customers, right? So let's say that in between there was a freight cost. So decided to Duffy and Thomas here, Duff and Thomas decided to uh, decided on the on decided to Duffy decided to pay the freight cost. So how Duffy is going to journalize this transaction is to increase inventory and then what? And then pay cash in this case. So if inventory is increased by some portion, then and cash is out, then this inventory the cost is transferred directly to customers. So Duffy has nothing to lose. So Duffy has nothing to lose, right? Um, it makes quite it makes sense, right? Okay, so for number two, it says Duffy paid $900 on merchandise purchased from Thomas. So he's going to increase the inventory by $900 and pay cash $900. Okay? All right. So number three. Number three, it says on April 7, purchased equipment on account, $26,000. Very simple. It's from our previous chapters. So he's going to increase the equipment, $26,000, and he is going to pay on account. So account payable, which is the same amount. Number four, it says on April 8, returned damaged merchandise to Thomas and was granted $2,600 credit for returned merchandise. So what it's saying is that Thomas has returned some products. Then what would happen? If Thomas returned product, his inventory amount will be decreased by 2,600. And he has no longer has the obligation to pay the same amount in the future, right? Okay. And number five, it says on April 15, paid amount due to Thomas in full. Okay, on April 15. So, but let's see the date of the purchase on April 5th, right? So, so April 5th to April 15. So it's within 10 days, right? Let's count. So purchased or 5 should be like this. If you minus this is 10 days, right? So you get 2% discount. You get 2% discount from where? From the amount minus your discount, not your returned products. So this is your purchase. So this is your return, and it will give us what? 400, and you have to multiply by 2 over 100 to get the amount that is discounted. So that will give us 448. Okay, so how to journalize this? So you're going to pay some money, right? You're going to pay some money. So there will be cash out by some amount. And you're going to reduce your account payable, which was this amount, because you already had this journal entry um, and this journal entry. So you only have account payable of this amount for this item. So you're going to pay some amount of cash, and you're going to have to record that your cost of purchasing this inventory has reduced by $448. So in the book, it says just treat inventory. Inventories are recorded at its cost. Inventory is recorded at its cost. So that means you can just treat inventory as cost if it's merchandise company. Okay? So that is it for number 2. Very easy question. So first, what you have to know here is that most important in this question is how are you going to treat the delivery expense? Are you going to view it as cost, or are you going to view it as expense? So for Thomas, if Thomas pays, Thomas is seller, and if Thomas pays the delivery, then it is expense. But buyer, Duffy, when buyer pays the delivery, it becomes cost. Okay? So this is quite tricky, so you should remember this. And freight on board shipping point and freight on board destination. Why do we have such rule? Because the ownership problem occur. Why? Because nobody wants to take responsibility in this world, right? So when the entity A send product to entity B, the entity A does not want to take responsibility while the goods are in transit. So goods in transit is another term that you should remember. Goods in transit, right? So during this travel, we don't know what's going to happen to this truck, right? This truck may collide with another truck, and your goods will be lost. So, if the ownership of the goods belong to the A, then A has to take responsibility. But if the ownership belongs to B and the truck collides, then B has to take responsibility of the damaged goods. So A and B has quite has has a conflict in interest, right? So A wants to give the ownership as soon as the A puts their goods in the truck, while B wants to have the ownership at the destination point. So and actually there are more rules on this. There are about 8, I think, but you only have to remember this 2, shipping point and destination, for this problem. Okay, so ownership problem occurs, and you have to take responsibility during goods in transit. That's why we buy insurance for this kind of transportation. And when you see, and this another concept, when products are purchased treat for buyers, if you treat freight cost as inventory, then you're actually transferring the delivery cost to the customer. So it has so Duffy had the buyer has nothing to lose. Okay, and 210 net 30 is another important concept here. So 210 net 30 um, is 2% discount for 10 days, net, so the full amount in 30 days. Okay, yeah. And you see here is that when the discount happens, using these method, you're going to decrease the cost of your inventory when this happens, when you pay in 10 days. Okay, all right, thank you for watching and hope you understand this chapter well. Ah, and for B, okay, for B, E, so what you're doing is you're not going to receive any um, you're not going to receive any discount on your product because you paid after 10 days. So it's very simple. You're going to have just pay full amount. Okay, all right, thank you for watching.